All right, good evening, everyone. Welcome to tonight's webinar. Tonight, we're focused on investing in the stock market. The webinar I did last night, which is, of course, on my YouTube channel at Stockscores, is all about day trading and swing trading. But tonight, we're going to shift gears and we're going to focus on the longer term style of trading. Many of the concepts that we use for position trading, which is what we're talking about tonight, are the same as for day trading and swing trading. So if you were here last night, you might hear some things that are repeated, but I'm going to show you some tools that we didn't use yesterday, the tools that I use to identify opportunities. Try to keep the presentation to about an hour. Let's dive in and just have a little look at the itinerary. So tonight, we're going to look at my approach to position trading, what it is, the basic concept. How do I know what stocks should be bought? And equally importantly, how to know what stocks should be avoided. I'll talk about the managing of risk. We'll go through some examples. And then ultimately, at the end of the presentation, we're going to scan the market for opportunities. Much like we did on Saturday, when we did a webinar on Saturday, I did a market scan. The top pick that day was MRT. I think it's up about 30% since then. So hopefully we'll be able to find something like that tonight. We'll do scans for stocks that are likely to go higher, but also I'll do a scan for stocks that pay dividends and that are worth considering if you're looking for that income. I'll talk about what I can do to help you in the market if you have an interest in using my tools and using my strategies. We'll talk about that. And then at the end, very end, I will take your stock questions. So if you'd like me to give some feedback on a particular stock, then that'll be your chance to ask there. Again, don't put those questions in now because my question box is small and the questions scroll up and out of sight for me. So just save those until the end. If you do have a question during the webinar, I will do my best to answer them at the end. I find that to keep the momentum and the flow going of the presentation, I like to hold off on those questions until then. All right, so let's jump right into it. The theory behind the Stockscores approach. My aim is simple. I want to find market-beating stocks. And by that, we mean stocks that do better than the overall market, which historically, if we look at the last 50 years, the S&P 500 over the last 50 years with dividends reinvested has averaged 11.3% return. Over the last 10 years, it's closer to 12.5%. So it's had a good run these last 10 years. But, if you just want to earn the market average, which is, a great return, you can double your money in 6 or 7 years with those kind of returns. If you want to do better than that, you have to start picking what we call alpha stocks. If you're happy with the market return, just go buy a low-cost index ETF like the S&P 500 ETF or something similar and do nothing. But if you want to beat the market, then the things that I'm going to teach you tonight will be helpful toward that aim. So let's look at my first example of what is a market-beating stock. This is a stock that went at the start of January was at $3, and as of this afternoon, it was sitting at around $11.50, $11.30. So that's a phenomenal gain. And I will show you as we go through tonight where I would buy this, why I would buy it there, where I would plan to lose if it was a bad pick, and even a potential sell point, which came up last month on this stock. But we'll dive into that a little later. So for now, this is a good example of a market-beating stock. It's made a huge return, 300–400% in just a few months. Now, why do stocks move in such strong trends? Well, this comes down to some basic theory about the stock market. The price of a stock is based upon its ability to make money in the future. Now, some companies don't make any money in the future, but the expectation is that one day they will. They may not make any money now, but one day they will make a profit. And it's the job of the stock market to figure out how much companies are going to make going forward. And the reason stocks move in strong trends is because information about the company's ability to make money in the future comes to investors, and they get excited about that future potential, and they are willing to buy the stock and accumulate the stock over time. So why would that happen? Well, you can imagine a gold miner. If the price of gold is going up, then the ability for that gold mining company to make more profit in the future is improving because the price of gold is rising, right? Or if it's a biotech company, and the biotech company is researching a new drug, and they get some good results on the effectiveness of that new drug, well, now they've got a drug that maybe will make them hundreds of millions or billions of dollars in the future. They have grown their ability to make money. So this comes down to the fundamentals of the company. You know, when you hear about people doing fundamental analysis, what they're really doing is trying to figure out what the company's going to make in the future. And I make that distinction, in the future, because it really doesn't matter what a stock made last year or last week for that matter, because that's already been priced into the stock. It's history. The market is solely concerned with the future. Now, it's not enough to say the market is concerned or, driven by the fundamentals of the company. I think it's a more accurate statement to say that the market is interested in the perception of fundamentals. And the reason I make that distinction between fundamentals and the perception of fundamentals is because human mood, our psychology, collective psychology, has a lot to do with how we judge information. If the economy is generally good, if the market is trending upward, then we're going to give much more value to the same fundamentals that we might not give that value to if the market was going down. So the mood of the market is very important, and that is what affects perception. So here is a stock that is in the mining sector, and we've seen strong performance in the price of gold and silver in the last couple of months. And you can see that with that strong price performance of the underlying commodities, this stock has done very well. Just this month, it's gone from around $11 a share to it hit 16.5 a couple of days ago. And so it's risen 50% almost in the month. Now, the company is essentially the same company, but what's most important is that their things that they mine, the stuff that they take out of the ground, is worth more. And so that improves their profitability. So you would expect that future earnings announcements about the company's profitability will be better in the next little while. And the market prices that in before it happens. And I think that's a really important thing to remember, is the market is forward looking. So if you are a person who reads news releases and makes decisions based on what you read in a news release from a company, you're actually doing yourself a disservice, because those news releases are already priced into the stock. If you read a release from a month ago that says, this biotech company has a treatment for cancer that was found to be 42% effective, great news, makes you think this must be a good company. But I assure you that that stock has already risen. And so looking at old news releases is useless. The market predicts the news before it comes out. And that really now drives my approach to trading the stock market. I have this recognition, and I learned this the hard way a long, long time ago, that the stock market is not fair. The spread of information about companies' ability to make money is not fair. Some people get better information than others. Now, some people get better information because they do the work to uncover things that are not widely known. If you're an expert in the mining sector or maybe you're an expert in cancer treatment, you probably know more about the companies that are researching new cancer treatments or who are drilling for new gold deposits because you're close to that industry. And so you have an advantage. And then, of course, there's the people that finance those companies. There's the people that run the companies and their friends, maybe the people they golf with on the weekend. So there's always some group of people that get better access to information than other people do. I think I talked last night about a study we did when I was in university in a class, my 4th year of university, where we looked at, whether there was evidence that people were trading on inside information before big news announcements came out, specifically before it was announced that one company was buying another company at a price premium. And we found over and over again that there was statistically significant abnormal market activity before big news announcements. And it could be good or bad. Sometimes the market is very good at predicting bad news as well. And I'm going to show you an example of that in just a moment. So when I was in business school, I was told, analyze the fundamentals of the company, look at their financial statements, look at their news releases, all of these things. And I did that for a while, and it didn't work for me. And the reason was that I was looking at publicly available information. I wasn't trying to figure out what the future information will be. And I wasn't an expert on anything. I wasn't an expert on oil and gas stocks or gold stocks or biotech stocks. I was someone who wanted to just trade the stock market. But what I learned after a couple of years of struggling was that the market was pretty good at telling me what those smart, well-informed people were doing. The people that had better information would go into the market and buy aggressively when something good was happening. Or, that institutional investor, that hedge fund, might sell a stock aggressively when they figured out that something bad was coming. And that leads me to this example. This is a chart of Lululemon. Now, right over here, there's this big price gap, big price drop. It went from just under $480 a share to $415 a share overnight. If you bought the stock at 480 and the next morning you wake up it's at 420, that's pretty depressing. And the reason that happened is the company issued earnings, and the earnings were actually good. But what wasn't good was the guidance that the company gave for future earnings. In their guidance, they said, we expect that our future earnings are going to be worse than they have been. And they cited all the reasons and that sort of thing. Okay, well, that news announcement was made after the market closed on this day. And so the next morning it opened here. There was no opportunity for you to get out early because once the news was out, the stock gapped down on the open and you suffered a 20% loss or so. However, what I want everyone to notice is this day right here. Because this for me is a classic sell signal. This is a signal that the market knew something bad was coming. The people that follow this stock the closest, the large institutional investors who, do all kinds of tactics to figure out how earnings are going to look. They'll do things like put people on a bench in a shopping mall and count traffic, and they buy research like that. There's companies, hedge funds that get satellite imagery of shopping malls at Christmas from above and count cars to figure out what kind of a shopping season it is going to be. There's all kinds of things that most of us could never do, but are done by large investors who want to gain an advantage by getting better information. Well, on this particular day, the stock made an abnormal move to the downside. It was statistically significant, and it traded more volume than it had traded for almost 6, 7 weeks. So in other words, something bad was predicted by the sellers that day. Now, one of the reasons I'll sell a stock is when its upward trend line is broken from a falling top. So I'm often asked, how do you know when to sell? This is a classic sell signal. When a stock that has been trending upward, as this one was, and then it goes parabolic like this, comes back to the trend line, okay, that's fine, and it runs along the trend line, that's also fine. But then when it breaks the trend line, like it did on that day, after making a high point that was lower than the previous high, that's called a breakdown from a falling top. And I talk about this in my videos all the time. It's a really strong sell signal, both for markets and individual stocks. And you can see that that got you out of this stock at $455 a share. And today, that stock is at $350 a share. I don't know anything about Lulu except that they make clothes. I might even be wearing one of their t-shirts right now. But what I do know is that the people who know the most were selling aggressively 7 weeks before earnings came out. And you can see the results. So the stock market is not always fair. And we see it on the upside as well. Many stocks will move up after this abnormal activity, and we'll look at some examples. Now, the fourth thing that's really critical to being a good investor is to realize that you will not be right all of the time. Whether you're day trading, swing trading, position trading, long-term investing, you will have some losers. It's inevitable. What's important is that you limit the size of your losses. You have to be a good loser. We talked about this in last night's webinar, and again, that's up on the Stockscores YouTube channel, so you can search for that on YouTube. The reason we have to take small losses is so that those small losses don't grow into big losses. So here's a chart of TELUS. This is a daily chart going back a year, back to April of 2023. And there were a couple of opportunities where there was a buy signal. The first was on this break of a downward trend line from a rising bottom. It's the exact opposite of why I said Lulu should have been sold a couple of months ago, right here. There was an abnormal day to the upside, breaking a downward trend line from a rising bottom. There was another buy signal right here when the stock made this rising bottom, this little sideways pattern. This is called an ascending triangle, and it broke out from that, and it did so with more volume than normal. That is a really good buy signal. And in that scenario, we buy on that day, and we plan to lose if it goes below this little floor here, which we call an inflection point. So it's an inflection point because it's the price point where price stopped going down and started going up. Okay, that's an inflection point low. And you can see that 3 or 4 weeks, well, 3 weeks later, it broke down through that floor. So if we bought at $25 and we're planning to lose at $23.75, okay, our buy point is 25 and our support price is $23.75. Our risk per share is $1.25. So if we buy 100 shares times $1.25 per share in risk, that means we're risking $125 on that trade. And we take that loss right there. We'd probably end up losing, with commissions and slippage, about $150. However, if we were still holding that stock, if we were stubborn and didn't take the small loss, now that stock is another $1.75 lower. And so instead of a $125 loss, it's now grown to a $300 loss. And there's really no sign that it's going to go up even from here. It's a pretty negative looking chart right now. The only good thing about this chart, I guess, is that there is a floor price from the old lows of October last year right here. And that's probably why it bounced. People remember that floor. But I would not be interested in buying the stock here. I would not want to hold this stock. And by taking the small loss after a reasonably good buy signal, I'm out, take the small loss, use the money for something else. And that's really, really important. Now, just as we want to have very little patience with our losers, we need to have good patience with our winners, because our winners have to pay for our losers. Now, let's say you do 10 trades, and of those 10, 4 are losers, and 6 are winners. If your average loss is $100, and your average win is $50, your losers cost you $400, and your winners make you $300. Now you're someone that has been right 60% of the time, which is decent success rate. And yet, even though you're right more than you're wrong, you're actually losing money because you don't let your winners win. Now let's try a little different scenario. Let's say you do 10 trades and you are right 5 times and you are wrong 5 times. On the times that you're right, you make $400. And on the times that you're wrong, you lose $100. That means your winners make you $2,000 and your losers lose $500. And so you have a profitable trading strategy, even though it's only right 50% of the time. If you were in grade school, you would get maybe a D, maybe an F. And so you can see that if you have big winners and small losers, you could even be right less than 50% and still be profitable overall. So when you have a winner, let it win. Here's an example of a stock that broke out a few times. Right here was a good one. And then it broke out again right here. Has optimism, resistance, breaking through resistance at roughly $22 a share. This was almost a year ago, back in July of 2023. You have to let the winner win. Now it broke its upward trend there, but no falling top. So it's still a hold. All that does is define the trend line. Now the trend line's gotten very steep. And so I would suggest, if you own this stock, that if it starts to go down below $60, sell it. But until then, let it run. It's having a little bit of a negative week this week, but the upward trend is still intact. And as long as the upward trend is in place, should stick with the trade. And by being patient, instead of taking, a small win by maybe selling when it started to show a little bit of weakness, when it's very easy to get worried that your winner is going to turn into a loser, instead of riding it from 22 to 30, which is a great return, instead you're now almost triple your money by being patient. Now, the things that we tell ourselves, because normal people make lots of emotional mistakes, is they'll say, whoa, I make 30% on this trade in just 3 months. You don't go broke making a profit. I don't want to be greedy. These are all the stupid things that investors tell themselves. And I say they're stupid because you have to let your winners win. If you have a strong stock, you don't get many stocks like this. You don't get the stocks that make these big long-term upward trends. So when you do, you have to let them win. There's a book out called How I Made $2 Million in the Stock Market. It was written a long time ago. I don't remember what year, but the author is Darvis. And, he went through all these phases trying to find success in the market. And he ultimately succeeded when he was really, really patient with his winners. And by the way, this was $2 million written, I think in the 50s. I could be wrong about that, 60s maybe. So that's when $2 million was probably worth more like $10 million. All right, and so I have a method for knowing when to sell these things using risk reward lines, using inflection points. I'm not going to touch on those methods tonight because that would be another 1 or 2 hour presentation, but the basic gist of it is every time there's an inflection point low, we move our stops up, and we can also just connect a dot across those inflection points and define a trend line by those and then sell if the trend line is broken. Could happen if it were to move below 60. So how do I pick good stocks? What do I focus on? Number one thing is abnormal trading activity. I look for stocks that are making price gains that are not normal and that are trading with more volume than normal. Now, this is a very important statement. Almost every market-beating stock starts its strong price trend, its outperformance, with abnormal activity, abnormal price gain with good volume. Okay, I'll say it again. Almost every market-beating stock starts its strong trend with abnormal price gain and strong volume. However, not all abnormal activity leads to market-beating moves. So we need a way to qualify what abnormal activity is more important than others. Now, towards the end of the presentation, we're going to do some market scans using my tools and look for stocks that are behaving abnormally. And when I do that, I will show you the pattern on the chart so we can determine if it's a predictive chart pattern. Now, one example of a predictive chart pattern is if a stock is moving up and then it pulls back and then it moves up and it hits the same price and stops and pulls back and sort of goes like this, where this might be $10 and this might be $20 and this might be 15 and 17, 20, 20, 19. This pattern is called an ascending triangle, and it tells the story of investor optimism, because every time price goes down, the sellers aren't able to push the stock as low as they had the previous time, and the result is you get these rising bottoms on the chart, which are a sign of optimism. So when you have a stock making rising bottoms, that's optimism. That's a good thing. We also can see that there's an upper limit on this chart. No one was willing to pay more than $20 a share through this time frame. But what if one day there's a group of investors that are now willing to pay 22? Why would they do that? Well, they do that because they have some new information, and maybe most of us don't know this information, but they have some new information that justifies paying a higher price. And so you'll have people buying there. I don't know why they're buying, but I know that it's the smart money that does that. It's the well-informed money. So when you get a breakout from an ascending triangle, which has optimism, it has diminishing price volatility, it has a ceiling price, and then you break out through that ceiling price with abnormal volume and abnormal price action, that is a strong reason to be a buyer of a stock. When that happens, you have to have good risk management. And so that means if I'm buying here at 22, I'm going to plan to sell if it goes down below 19, because that is my last inflection point low. And so the difference between that two is the risk. In this case, it's $3. I'm buying at 22. I'm going to plan to lose at 19. That means I'm risking $3 a share. If I'm willing to lose $300 on any one trade, then I'm going to buy 100 shares. Okay, I'll let that sink in for a second. Now it's important to be a good loser. If you buy that breakout at 22 and you have your stop loss at 19 and it goes up to 24 and then comes down and goes down through your floor, you have to take that loss. As long as you're putting your stop at the right place, you have to take your loss. Now, some people will say, oh, I'm going to sell if the stock goes down 10%. So they put their stop at $20. Well, that's actually not the right thing to do, because that $20 price level that they're using for their stop is an arbitrary number based upon a simple percentage. It's not based on the opinion of the market. You should always put your stops at floors defined by the stock market. And so we always do that at the last inflection point low. So if we go back to the TELUS chart, if I can get back to that. Okay, so on TELUS, there was a floor defined there. It's the point where price stopped going down and started going up. And so when it penetrated that floor, it implied that investors had some new information that made them pessimistic or worried about the company, because they pushed the stock to a price level that hadn't been seen for a number of weeks. And it's probably because there was some well-informed investors that knew that bad things were coming for the future earnings potential of TELUS. Now, again, when we are in a good trade, we are going to be patient. We are going to let that profit run and just keep moving our stops up as it makes new inflection point lows. And we have some other methods using something called reward for risk lines, which I can teach you in the investor course that I'll talk about in a little bit. We are not aiming to get in at the low or out at the high. The most expensive way to buy stocks is to try to buy it at the low, because you say, oh, it's gone down a lot, that's got to be the low, and then it goes down some more. Oh, I'm going to try to buy at that low, and it goes down some more. And you're just chasing a falling knife, trying to catch a falling knife. By the same token, when the stock's trending up, you say, oh, it really had a good run, I'm going to try to sell there and lock in that profit. And then it makes a little pullback and you think, oh, I'm pretty smart. And then it goes to new highs and you miss out on another 10, 15% of the move. So we are going to sell stocks when they break their upward trends. We're going to think about buying stocks when they break their downward trends from rising bottoms. That's a very simple approach. There's other things that we're going to do, obviously, that improve our probabilities, but that's one of the basic concepts. So here is the stock that we showed at the top. There is a line of resistance, the ceiling price that has been hit multiple times. There is optimism because there's rising bottoms. There's low price volatility here because the stock is basically going sideways, whereas here you've got volatility, lots of price swings. And then most importantly, we break through resistance with abnormal volume from optimism, from low volatility. Those things that I just mentioned are the Stockscores simple strategy for position trading. Now I teach, 4 or 5 different position trading strategies. That's the basic concepts of one of them. And on Saturday, at that webinar that we do on Saturday, we'll dive into how you learn these things and what the rules are and how they're shared through my website. But that's sort of a little tidbit on one of those strategies. So if you want to do this kind of work, if you want to search for stocks making this breakout through resistance, from optimism, from low volatility, you need a tool and you need a little bit of time. How much time do you need? Well, if you want to be what I call a more aggressive position trader, where you're doing entry signals based on the daily chart, It takes about 15 minutes a day. Now, before we started tonight, I did a little survey, and basically half of you said that you do your stock market research during the trading day. Okay, great. So I would run this process about half an hour before the market closes if you're doing your work during the trading day. Now, if you go to work every day and you don't have the time to look at the market during the day, that's fine. You can do it in the evenings. It's okay that you just enter the trades the next day. And if you don't want to do anything during the day, if you want to be a lot less active, then you can do these things on the weekend. I think 15 or 17% of you said you do your research on the weekend. That's totally fine. Do 10, 15 trades a year. It's going to take you 15 minutes a week. Now I have strategies for the different types. So if you're a 15-minute a day person for position trading, those are the strategies you're going to focus on. If you like to do it on the weekends, those are the strategies you're going to focus on. So how do we find opportunities? I have a tool called the Stockscores Market Scan. So we'll jump into the Stockscores website now. And just a reminder, we've got another webinar on Saturday, so you can register for that right here. And in that webinar, I'll talk about my tools and the education offerings that we have. But let me show you the primary tool on Stockscores. It's called the Market Scan, and it has all these filters available to us. So let's say I'm a Canadian, I'm looking for a stock to put in my retirement savings, my RRSP. I could say search all Canadian markets for stocks that are greater than $2, that have a sentiment stock score of at least 50 and pay a dividend of at least 3%. So where's my dividend? Here it is. So dividend yield of at least 3%. And just so I don't get stocks that are really illiquid, I will also say that it has to trade at least 200 times a day. Okay, run the scan. It just went through every stock in Canada, and it found 78 that meet those criteria. Now you could see from that tool that I showed you, there's many, many different filters. But we ran a little basic scan, and then we look at the charts to see if they have a good chart pattern. So first up is this in-play oil. Let's look at a 3-year chart of this stock. I can see that it is breaking its downward trend line from a rising bottom. It just broke out last week. Looks pretty good. Wish the volume was a little stronger, but I think this has got decent potential, and it pays a yield. Now, I've looked at this one before. I know that the yield is about 7%, so it's a pretty healthy yield. Let's go to the next one. Okay, this stock has got good upward momentum, but not really breaking out of the pattern, so not that interesting. More a hold if you were in it. This stock made a break of a downward trend line from a rising bottom about 4 days ago. At $3.80, it's at $3.95 now. It's up a little bit. It's okay. If I look at the 3-year chart, I see that it's still below its downward trend line. So now I like it a little less because the sellers are still in control of this stock. Go to the next one. Now, as you get good at this, you can start to go through these really, really quick because it's just a skill that you have to learn and practice. And if you get where you're really fast at it, you can do something called the gallery view, where now I can look at these charts 10 per page, so I can cycle through them really quickly. I will teach you what to look for, and then you have to practice to get good at it. Here's another one that looks pretty good. Downward trend line broken from a rising bottom. Not real abnormal activity yet. Pays a healthy yield, 7%. Looks like it's starting to turn. I don't think it's quite time yet. I'd like to see it make a good break through this ceiling at about 575, but it's a stock to watch. All right, so that's the market scan in a quick and dirty version. And I will show you this tool more on Saturday. We'll spend a little more time with this. One of the things that I'll just say before we move on is that you don't have to know how to set this up. Like I built a scan on the fly because I've built scans for you. So if you are in the US and you want to find stocks making abnormal breaks, you just run this preset. Abnormal breaks US, run the market scan. It found 44. I'm going to view the charts to see if any of these are worth considering. Now, if you wanted to know what that scan does, I go to Trader Training, Education Center. I slide down to the investor section, and there is a strategy called abnormal breaks. I can read the lesson, or I can watch the video, snazzy music, and I will teach you in that 12-minute video how that strategy works. So again, those are things that we'll talk about on Saturday, but I just wanted to give you a quick sense of this. We're going to come back to this tool because I will do another market scan. We'll try to find something that looks good. Okay, we're going to do some abnormal break scan. We'll do that in a little bit. Before we get there, let's finish up on this education center and what that's all about. When we were in the education center, there was a number of different functional areas. There was the foundation area, which is the theory. Okay, so this is just how to read stock charts, how to manage risk, what's a candlestick chart, what is volume and why is that important, what are these different patterns, that's all foundation stuff. And then in the investor section, I teach you the specific rules for when to buy and sell if you are an investor. And in the active trader section, I teach you the specific rules for when to buy and sell if you are a day trader or a swing trader. If you take my investor course or you buy the investor membership on Stockscores, you get access to the foundation lessons, the theory, you get access to the investor strategies, you get access to the market scans on Stockscores for investing, you get email support from me. I only teach about 100 people a year, probably not even 100, less than 100 people per year. And so I can give that fairly personalized support. I am a stock trader first and foremost. I do teaching on the side because A, I enjoy it, B, I like having a business that gives me that stability of earnings. And so I teach 100 people a year. I don't want to teach more than that. And you can be one of those 100 if you like. We'll talk more about that on Saturday and a little bit later in this presentation as well. That tool that I showed you, which is the market scan tool, is $300 a year. You get 6 months for free when you register as an investor member or an active trader member for that matter. And it's then $300 a year to keep your membership up. Now the active trader course is the same stuff. You get the same investor things, but you also get access to the active trader strategies for day and swing trading. You get access to the active trader market scans. You get access to my proprietary real-time indicators for TradeStation, which I've spent 15, 20 years creating and thousands of dollars in programming costs to build those things. And it makes you eligible for our day and swing trading service called Active Live. We have a group of traders every day that hang out with me and monitor this screen. I showed that in last night's webinar. I won't talk about it much more. But that Active Live allows you to see my analysis screen in real time. You're watching me create and monitor the market for day trades and swing trades. It's real time. It's a live webinar we run every day from market open to market close. Automated instant trade signals, much of it just driven by the computer doing algorithmic analysis of the market. And so the computer and myself are doing the work so that you can focus on evaluating the trades. This particular service, Active Live for day and swing traders, is only available to Stockscores active trader members. It's $245 a month, and you get a free month with the active trader course. Now, as I talked about last night, every year around this time, I complement the online material that's in the education center with some live training just to help you learn it better. And so that starts on Monday, April 22nd. We're going to do an hour-and-a-half long class on Monday, an hour-and-a-half on Tuesday. That's going to teach you the theory. And then on Wednesday, Thursday, and Saturday of that week, we're going to practice market scanning. And again, we're going to do a market scan together in a moment, but we'll do multiple market scans on these days. And I'm just going to practice and teach you how to read charts, how to do risk management, how to be fussy, how to know one stock's worth buying and one stock isn't. I'll show you how to do that. It takes practice, but it's not complicated. You don't have to have a background in finance or math. You have to be able to draw a straight line with a ruler. It's really that simple, but you have to know a few basic things that take me a little while to show you. In addition, if you are an active trader member, if you choose that course, then you get a free month of my active live service where you can watch my analysis all day. All of these classes, well, all of the investor classes, the overview classes, those are recorded. I record parts of the active live sessions, but not all day because it slows down my computers too much. But at the end of the day, I do probably 4 or 5 recorded lessons each month, always building on skills. And we have a library of over 100 little videos that I've done for active traders for the active live members. So here is the special offer. Anyone who registers for the investor or active trader course by Thursday, April 18th at 11 p.m. Pacific time, we'll get those live classes starting April 22nd for free. You'll get the express class Monday and Tuesday. You'll get the market scanning Wednesday, Thursday, Saturday. And if you choose to do the active trader course, which includes the investor course, you'll also get a free month of active live, which you can use at any time. So you may say, well, I don't want to start actually using that until September. No problem. You just email me at the end of August and I'll set you up with active live for September. Cost, $29.95 for the investor course, $39.95 for the active trader course. The other option is the mentorship course, which includes active trader, which includes investor, but it also includes 14 one-hour classes over the next 6 weeks where I will walk you through all the material personally. That's restricted to only 15 students, and there's currently 6 spots left for the mentorship. There's 9 people already signed up for it. Okay, if you took the investor course last year and you want to upgrade to the active trader course, you can do that. It's $1,250. And if you took the active trader course last year and you want to upgrade to the mentorship, you just pay the difference, $2,000. And even better, if you would like $500 off of this, or off of this, or off of this, then just use these codes. So you register for the active trader course, you punch in this code, it'll give you a $500 discount. If you register for the investor course, $500 off with that code. The $500 discount does not apply to the upgrade from investor to active, only for the original purchase of the class and the membership. Now to do so, sorry, that says October 19th, that should be April 18th. I have an old slide in here. To do that, you just go to the Stockscores website, go to Trader Training, learn how to trade. Lots of information on this page about how the strategies work, as well as where you can order. Enter discount code 500ATA24, apply discount. There it is. You'll see here this $300 yearly. You don't get charged that now. You only get charged that in 6 months, and you can cancel before if you don't want to continue using that tool. You will be charged this, and if you're Canadian, you'll be charged GST. If you're from somewhere else in the world, you're paying in Canadian dollars. There's no taxes for people outside of Canada. Now, we are going to do a market scan in a minute, and we're going to analyze your stocks, so stick around. But before I do that, I'm just going to launch this poll. As I said last night, I don't like to bug people with spam or anything like that. So if you want some follow-up emails from me on the course details, just answer this. If you've already answered it, you don't need to answer it again. But like if you answered it in yesterday or Saturday's webinar, you don't need to answer again. And unless you have a change of heart, you can tell me that. But anyway, the way to get those follow-up emails after Saturday's webinar, I'll have a few emails out, is just to say yes to this. I'll leave it up for a minute. In the meantime, a couple of questions. Do you get access to the scanners and indicators for life? Well, you have to pay $300 a year, so it's not for life, no. Because those tools, like the market scan tool, I have to buy data from the exchanges every month. It costs about $5,000 a month. So that $300 is just basically covering our data costs. Most days you are day and swing trading. Do you pay attention to the key market indicators like the CPI or Fed statements? I don't care. It shows up in the market action and I follow market action. So it's not that it doesn't matter, it totally matters, but I don't care what the words are, I care what the market's reaction to the words are. And so that's really important. All right, another question. Do you trade options using these strategies? I personally do not, but many of my students do. It's a way to leverage your picks. Should you let stocks play around your stop loss before selling or sell immediately? I look for, when I'm position trading, I look for the stock to close below support, not just hit support. Okay, I'm going to shut down the poll. Where do I do that? Here we go. So thanks for answering. And again, this is the screen where, I don't know if I showed you this. To register, you go to learn how to trade, you click on this, and then you just complete the thing. You enter your discount code here, okay? We'll get out of that now. I'll answer a few more questions and then we will do a market scan and then I will answer your stock questions. So if a stock provides buy signals and goes above resistance, at what point do you buy? I buy on the daily chart. I buy when it closes above resistance, when it meets the rules, not when it simply goes through it. For the daily chart, the daily has to be closing above resistance, or like I said, in the final half an hour, you can usually tell if it's going to close above. What is your current view on Canadian oil and gas producers, buy, sell, or hold? Depends. Like some of them have already run away. So if we think about Cenovus, CVE, okay, this one's already had its run. I was mountain biking with my friend right about here, and I told him he should buy Cenovus that day because it was doing what we talked about earlier, downward trend, build a rising bottom, breaking up from a rising bottom, and now it's up from 23.5 to 29. Those are the larger companies. Where there's a lag is in the smaller companies. So a company like T.SGY, it broke, right here. So that one's run away a little bit. The other one that I showed you earlier, T.IPO, is just starting to break. So there you can see the rising bottom breaking out. I think that one looks pretty good. That one's got a decent yield. I think it was 7.14%. So a lot of these juniors, I think, are going to start to catch up. I think the larger players have already run a little bit away. And so I would only consider them on pullbacks. Now, if we take a look at the index ETF, there's the energy ETF. You can see it's gone straight up. And so most stocks have already left the station. The bus has left the station. Where there's an exception to that is in the small cap oil producers, an IPO being a good example in Toronto. Okay, let's do a market scan and then I'll come back to some of these other stock questions because there's a few that have been submitted. So what we're going to do now is we're going to run a scan called Abnormal Breaks US. This particular scan looks for US listed stocks that have made an abnormal day up, are breaking through 15-day resistance, and trade at least 1,000 times. I like to run the scan every day. It's kind of my favorite for finding position trades. And let's look through these and evaluate if they're any good. Now this one, I can see had an abnormal day to the upside, had abnormal volume, but it's not breaking through resistance and there's no optimism. There's no rising bottoms. So for that reason, it's a no. So I go to the next one. I see again, a good strong price jump today, but breaking a downward trend line, no rising bottom. So it's interesting. I think it might do well, but not good enough for me. Now this has got a really skewed chart because it got pummeled back in December. I'm just going to zoom in on this a little bit so we can read it a little better. So good volume today, trying to break out, a little volatile. It's okay, but I don't think it's outstanding. This one, too late. But when did this one do it? Hopefully some of you see it. There's resistance. There's the breakout. There's the optimism. That was at 70 cents. And today the stock hit $1.60. I actually day traded this stock today. I'll just show you why. Here's the 2-day chart. And if I zoom in on this, see how it made this little, it was abnormal today. See the abnormal volume? And it made this little pullback. We call this an early riser setup. So I bought it right there. And it had a good little move, and then it broke the upward trend about there. All right, continuing along. I'm going to scroll through these a little quicker. This TOON is not bad. It's got resistance. It's breaking out. It's got rising bottoms. The reason I say not, and it's got abnormal volume, the reason I say not bad is it's a little bit volatile before the break. So that increases the chance that it will pull back. So my preference in that scenario is to wait for a pullback because I think it's probably going to happen. If I look at the 10-day chart here, see how this is trending up and it's kind of run away. What I would watch for in this stock is for it to pull back and then break the pullback. And if it does that, then I think it's worth considering. Okay, so that's TOON. I think somebody asked me about this stock in the questions. Yeah, someone asked about that, and there's your answer right there. This is too much pessimism, too much resistance, big gap makes the reward for risk not work. Now you'll notice I have a reason why I'm passing on all of these. All of these reasons are what I teach you in the course material. And it takes a little bit of practice, of course, but once you, here's a stock that broke out a little over a week ago maybe. There's resistance, there's the breakout, there's the optimism, low volatility, that was at 475. Now it's almost at 650. Too late now, it's a good hold, but I wouldn't chase it here. Okay, next page. Little break there, not bad, no volume and resistance here. So I don't think it's good enough. This has got too much pessimism. There's no rising bottoms. This looks like the start of a turnaround. It's breaking through this resistance. Good abnormal price, really abnormal volume. Probably run into resistance up there. So then I think about reward for risk. So buying here, support there. It's got 1, 2, 3.5 times reward for risk potential. Pretty good. The negatives, it's a little bit volatile before the break. It'll show up more if I look at a 10-day chart. You can see it's been kind of going up for a while now. Again, maybe on a pullback. So if it pulls back to this level around 15.50 and then starts to break the pullback, I like it better. Right now, I'd give it a 6.5. I'll rent the runway. Lots of pessimism. Was a good day trader today. I day traded this today, but not suitable for position trading. And that's an important thing. You know, I can look at a stock and say, as a position trader, I don't want to touch it. But the same stock, I can look at the short-term chart. As a day trader, I can say, oh, it's made a little breakout right there. I could ride it from here to there. Quick little profit. I actually bought this stock right here, right there, because it broke this little downward trend line. Wasn't a huge winner, made a small profit by the end of the day. All right, so I'll just go through a couple more pages of these and then I'll answer your questions. This stock is trying to break the downward trend. So here's a downward trend, rising bottom, breaking the downward trend. Volume is good, but not great. It has a decent yield, 6.8%. You can see that right here. So I'd give that a 6 out of 10. When I say 6 out of 10, I mean it has a 60% chance of working. All right, now let's take a look at some of your questions. Someone asking about Vino as a swing trade, VINO, and we have to jump into like a 10-day chart. So if you're in this, if you bought this pullback break right here, this is a strategy I teach in my active trader course called an alpha echo. And so that was a good buy point. It's building optimism. It's got this ascending triangle building. I think it looks good. If you're in it, I would hold. And hopefully tomorrow it breaks through that resistance level. So it looks okay. Next one, T.ZDV. Is it showing a sell signal? Well, it had a breakdown today. We can see that. There's your upward trend line. So it hasn't broken that. It's just broken this very short-term line, and it's doing so after hitting a new high. So it may pull back to here, but I wouldn't say it's a long-term sell signal. I'm going to take a quick look at the 3-year chart. One of the problems is that it's bumping up against this resistance level. See how many times it's hit this price level? And it's hitting it again. So I don't think it's a sell signal. I do think you're going to probably have to be a little bit patient in the short term because it's probably going to go sideways a bit. Okay, CTS. Someone asking buy, hold, or sell. Just going to take a look. I would say it's a hold. Don't see a good reason to buy it, but if you're in it, I would hold on to it. I wouldn't sell it. And next up is T.ATH. And lots of questions are coming in. I'm never going to get all of them, but I'll try my best. This is a hold. If you're in this, it's in an upward trend. It broke out yesterday, but broke out from a choppy pattern. It really started its move a while ago. So I think it's a hold. I would not buy it here, but if you're in it, I would hang on to it. Looks good for now. Paramount, POU on the Toronto Exchange, quite volatile. Whoops. So quite volatile there. But if you're in it, it's a hold. I think it's probably going to get stuck here. It's hard to predict. Just the stock is so volatile the way it moves around all over the place. It's a very hard stock to predict. So it's hard for me to give you a good sense of where that's going to go. Someone asking about Altria. Whoops. MO. I would stay out of it. It's not really got a lot of downside because it has good support in here, but it's a negative chart. I'm just going to look at the 3-year. Yeah, I see no reason to be in this stock. Does not look great. BSGM. Breaking up into pessimism, so I would not be a position trader of this stock. It's had some good abnormal volume. We've sort of day traded and swing traded this stock the last few days, and it had some opportunities today, not so much. I would say slightly negative on this for the short term. I think the fact that it kind of is building this negative pattern, it could break down, so I don't love it. Pan Atlas Silver T.PAAS, Pan American Silver. Hold, not a buy. If you're in it, ride it until the upward trend is broken. I would watch this on this intraday chart, and I'd be looking to sell if it breaks this upward trend line from a falling top. This is a 2-hour chart, 30-day 2-hour chart. You could make it a 60-minute chart as well, but look for a break of that upward trend line. When did this stock have a buy signal? Resistance, optimism, low volatility, breakout. A lot of the things we've talked about tonight. I'm going to look at one more, and that's TD Bank, T.TD. I would stay out of this stock. It is negative. The trend is down. You can see the tops are falling. Okay, that's a sign of pessimism. It's got support here. If it breaks down through this support level, it's likely to go even lower. For me to like this, it's got to start to build some rising bottoms and break through some resistance. And I don't see that happening anytime soon. All right, so I'm going to wrap it up there. I want to just jump back into this. I'll leave that up, and I'm just going to check if there was any general questions that I've missed while you can sort of take a look at some comments from some of my past students. I don't think I've missed any of the general questions. Oh, there's a question. Please explain signal and sentiment stock scores. That's a bit of a longer conversation, but I'll show you where there's a video where you can get an explanation. So if you go to Trader Training, go to Education Center, and go to Getting Started right here. There is a video right here, the stock scores indicators, and there's a video that explains it. So just a short little video that'll explain that for you. Okay, I think that's about it. I'll just pop this up again. If you want to register for the course, the sooner you register, the sooner you can start learning. The deadline to register for the discounts and the bonus live training is Thursday of next week, April 18th. I'll do a class, again, a webinar on Saturday. So make sure you're registered for that, because I will go through the tools in more detail. I'll go through the course material in more detail, and we might even have time to look at a few more stocks then. So thanks everyone for joining me. I hope you've enjoyed it, and we'll see you Saturday. Bye for now.